You weren't supposed to hear this, and if you're still listening in the next 10 seconds, you're already ahead of most people. Because what just happened to gold and silver isn't a normal market move. It's a message, a quiet one, sent between institutions, whispered through price candles, and designed to scare the wrong people out while the right people move in. This is the part of the story where the numbers don't matter nearly as much as the timing, the psychology, and who benefits when fear hits all at once. Before we go any further, understand this. Nothing you're about to hear is taught in schools, it's not explained on mainstream finance TV, and it's definitely not pushed by people who make money selling hope to retail investors. So if you want real financial truths they don't teach, hit subscribe and turn on notifications. You don't want to miss what's coming. On the surface, the headlines are simple: gold fell, silver collapsed, the rebound didn't last, and everyone is pretending this is just another reaction to the dollar or interest rates or some bureaucratic delay in economic data. But beneath that surface is a much older game, one that's been played for decades, where metals, currencies, and now crypto are used as pressure valves in a system that can't tell the truth without collapsing confidence. When gold drops 3% in a single session and silver gets obliterated by double digits, that's not random volatility, that's a controlled release of tension. Most people see red candles and feel panic. They see a plunge in silver and think something is broken. They feel stupid for buying the rebound or ashamed for missing the top. And that emotional response is exactly the point. Markets don't move money, they move people, and people move money after their emotions have already been hacked. Fear always arrives first, logic shows up late, and by then the real transfer has already happened. Let's slow this down and really look at what just unfolded, because this wasn't only about metals, it was about liquidity, positioning, and a signal sent from the top of the monetary pyramid. Silver didn't just fall, it was routed, starting in Chinese markets, spilling out of Shanghai futures like a controlled demolition, cascading into spot prices, and wiping out a rebound that never had time to build real confidence. That rebound was bait, and bait only works if you let people taste hope before you pull it away. Gold followed, not as violently, but with enough force to remind everyone that even the so-called safe havens are only safe when the system allows them to be. Platinum slid, copper softened, the entire complex leaned over at the same time, and the official explanation was a stronger dollar and uncertainty around Federal Reserve policy. That's true, but it's not the truth. Here's the part most people never connect. The dollar didn't strengthen by accident, and it didn't strengthen for you. The timing matters. A key jobs report gets delayed. A new Federal Reserve Chair nominee is announced. Global central banks hold rates steady. On paper, it looks boring, procedural, almost dull. In reality, it's the perfect backdrop to reprice assets quietly while everyone argues about inflation, politics, and headlines that don't change anything. When Donald Trump nominated Kevin Warsh as the next Fed chair, markets didn't react because of his resume. They reacted because of what he represents. Warsh isn't seen as soft. He isn't expected to flood markets with easy money just to keep asset prices floating. Even if rates fall, the message is that liquidity won't be free, and when liquidity tightens, everything leveraged starts to bleed. That includes metals, especially the ones retail investors treat like lottery tickets instead of strategic assets. Silver is a special case, and that's why its collapse matters more than gold's pullback. Silver lives in two worlds at once. It's a precious metal and an industrial input, a store of value and a consumable resource. That dual identity makes it incredibly sensitive to narrative shifts. When growth optimism fades, industrial demand fears kick in. When inflation fear spikes, speculative money piles in. And when both narratives wobble at the same time, silver gets torn apart. But here's the twist. The fundamentals behind silver didn't disappear overnight. They didn't vanish during that crash. Industrial demand didn't evaporate. Physical supply constraints didn't magically resolve themselves. What changed was positioning. What changed was confidence. And confidence is the most valuable currency in any market because once it breaks, prices can be pushed far below fair value while smart money waits patiently. This is where the real game starts, because while retail investors are staring at charts, institutions are watching behavior. They're watching who sells into panic, who gets liquidated, who over-leveraged on the rebound, and who's now emotionally exhausted. These violent moves reset positioning. They flush out weak hands. They create liquidity where there was none, and they do it without announcing anything. The media will tell you this is sensitivity to the dollar, yield repricing, uncertainty around Fed policy. Those words sound technical, safe, almost comforting, but what they really mean is this. The system needed a reason to push prices lower without admitting why. Media narratives aren't designed to explain reality. They're designed to keep you calm enough to participate while confused enough not to question the structure. The human mind is the real battlefield here. Fear doesn't just make people sell, it narrows perception. Greed doesn't just make people buy, it blinds intelligence. Herd mentality fills the gaps when people don't understand what's happening, and FOMO becomes the leash that pulls them into bad timing. Whales don't beat retail because they're smarter. They beat retail because they're calmer, better capitalized, and never emotionally attached to a single outcome. Think about what just happened. Silver drops nearly 13% in a day after already losing 16% earlier. That kind of move destroys confidence. It makes people swear off the asset entirely. It convinces them it's too dangerous, too manipulated, too stressful. And right when that emotional conclusion sets in, that's when accumulation quietly begins. This isn't new. This is how wealth has always moved. Silent transfers happen during chaos, not stability. Asset repricing cycles don't announce themselves with clarity. They disguise themselves as failure. When prices fall violently, the story becomes about risk, about uncertainty, about why it's smarter to stay away. That story is repeated until selling pressure dries up. Then, without warning, price stabilizes, volume changes, and something that felt dead starts to breathe again. Gold's pullback plays a different psychological role. Gold is still treated as the ultimate hedge, the final insurance policy. When gold falls alongside risk assets, it shakes belief. It makes people question whether anything is real anymore. That doubt is powerful. It pushes people toward cash, toward dollars, toward the illusion of safety provided by the same system quietly eroding purchasing power through inflation and debt. Currency debasement doesn't happen loudly. It happens slowly, then suddenly. Inflation decay is masked by nominal numbers. You're told your portfolio is up, your wages increased, your economy is growing, but your real buying power keeps slipping. Metals, crypto, and hard assets are the escape valves from that decay, which is why their prices are managed so carefully. Crypto fits into this story more than most people realize. When metals get slammed, crypto narratives shift. Money doesn't disappear, it rotates. Whales move between asset classes, exploiting correlation breaks and psychological exhaustion. Retail investors chase whatever feels alive. Institutions position where fear is highest and liquidity is cheapest. The recent metal sell-off isn't isolated. It's part of a broader liquidity cycle. Tightening here, easing there, squeezing leverage out of the system while maintaining the appearance of control. The dollar strengthens not because it's strong, but because everything else is temporarily weakened. That relative strength is enough to pressure commodities priced in dollars, and that pressure is enough to force hands. Here's what most people miss. The goal isn't to crush prices forever, it's to shake conviction at critical moments. Markets don't need to be fair, they just need to function. And they function best when participants are emotionally reactive rather than strategically patient. This is why rebounds are often short-lived before major moves. A quick bounce restores just enough hope to draw people back in, to rebuild leverage, to create targets. Then the floor drops. Confidence gets hit harder the second time. People swear they'll never touch it again. That's when the cycle resets. When Christopher Wong talks about choppier two-way trading and confidence not being fully restored, he's describing the aftermath of a psychological shock. Choppy markets exhaust participants. They drain attention, capital, and belief. That environment favors those who can wait, those who don't need immediate validation, those who understand that time is an asset. Meanwhile, behind closed doors, elite positioning adjusts, balance sheets are rebalanced, exposure shifts quietly, no press releases, no alerts, just slow, deliberate moves that only show up in hindsight. This is why watching price alone will never tell you the full story. Price is the last thing to move. Psychology moves first, narrative moves second, positioning moves third, price follows when it's already too late for most. The delayed jobs report, the central banks holding rates, the Fed chair nomination, these are not random backdrops. They're convenient fog. While attention is scattered, while debates rage about politics and policy, the real work gets done. And here's the uncomfortable truth. The system doesn't need you to lose, it just needs you to behave predictably. It needs you to buy when confidence is high and sell when fear peaks. It needs you to believe the story you're told at the exact wrong moment. That's how liquidity traps work. That's how silent wealth transfers happen without anyone breaking a law. Real value doesn't disappear when price falls. Fake money doesn't become real just because numbers go up. The difference between the two is patience and understanding. Power lives in secrecy. Control lives in narrative. Mystery lives in the gaps between what you're shown and what's actually happening. So where does this leave you? Watching gold slip and silver collapse, feeling like the ground is unstable? It leaves you with a choice. You can react like the herd, emotionally drained, chasing certainty where none exists, or you can start seeing markets as psychological systems first and financial systems second. This moment isn't about predicting the next tick. It's about recognizing the phase. We're in a reset window. Positioning is being cleaned. Weak conviction is being removed. Confidence is being tested. That doesn't mean prices can't go lower. It means volatility is doing its job. The warning is simple but hard to follow. Don't confuse violence with failure. Don't confuse fear with truth. And don't assume that because something feels manipulated, it's therefore useless. Manipulation is how systems survive. Understanding it is how individuals do. Legendary wealth isn't built by knowing what everyone knows. It's built by understanding what everyone feels and acting differently. Most people will never understand this because it requires sitting with discomfort, ignoring noise, and thinking in cycles instead of headlines. So here's the question I want you to answer in the comments. When the next wave of fear hits, will you see it as a threat or as a signal? Send this to someone who needs to hear it, because the people who understand this early never talk about it later. And if you want to stay ahead of the narratives, subscribe, turn on notifications, and remember this: the most dangerous secrets aren't hidden, they're ignored.